Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Today we're going to be covering bond investing, and more specifically, there are certain market environments where bonds can lose value, and 2022 has been no exception to that. As of May of this year, the aggregate bond index is down about 8% for the year, which is pretty major for bonds to lose that amount of value. So I'm going to take you through some of the ins and outs of bonds, like interest rate risk, default risk, coupon payments. You can understand in certain market environments why bonds can lose value. Before I get into the intricacies of how these bonds work, let's first talk about at a basic level what a bond is. A bond is just essentially a loan. It's a loan being made by a company, a government entity, a country, and they're asking for those loans so they can finance their operations. And you as the person buying the bond are actually the one lending the money. So if a company is saying, hey, we're going to issue a bond for $10,000 for 10 years, you lend them your $10,000, they pay you interest over the life of that bond, and then at the end of 10 years, that's when they return your $10,000. While high quality bonds are often viewed as a safer investment than stocks, it's important to acknowledge that there's still risk. Similar to a loan, if you lend a company money and they go bankrupt before that loan is set to come due, you could be out that principal that you lent to them. And bonds have other risks involved, like interest rate risk, which is what the bond market's seeing this year, which we're going to cover in this video. Because there are risks with these bonds, creditworthiness of the bond issuer is very, very important, because you have to trust that whoever is issuing that bond can make those interest payments to you and return your principal 5, 10 years, or 20 years, or whenever the duration of that bond is due. So when you look at like a US government bond, they're typically viewed as one of the safer bonds in the world, because in order to make those interest payments and principal payments at the bond's maturity, the government can always print more money, they can tax us more, so it's viewed as a safer investment. Versus a company, if they issue a bond, they come in hard times and they end up in bankruptcy, they might not be able to make those interest payments or return your bond principal. Fortunately for investors, there are rating agencies out there that help you to determine the credit worthiness of a bond issuer. And the two of the main ones are Standard & Poor's and Moody's. And they assign a grade to these issuers of either AAA for the highest all the way down to D for the lowest issuers, determine what's the credit risk associated with that bond issuance. Now, while that helps, and it's important to consider both, because Moody's could have one opinion and S&P could have another, you also have to do your own due diligence, because as we saw during the 08-09 recession, like sometimes they get it wrong. Sometimes even their grading system is not correct and there's more risk than bond investors expect. If investments end up in a situation where a bond defaults, it's kind of ugly, because if a company goes into, let's say, bankruptcy, all their creditors start lining up, including the bondholders. And even though bondholders oftentimes stand before the stockholders of the company, there may not be enough in assets of that company to repay you the face value of your bond. So if you bought that bond for $10,000, company goes into bankruptcy, when it all shakes out, you might only get $5,000 back or none of it back, depending on how many other claims are standing in line ahead of you. Let's cover bond coupon payments, also known as interest payments. So if you have a bond that's paying a 5% coupon, that means that bond investor is getting 5% per year over the life of that bond in the form of interest. And the interest of bonds issued varies, and a lot of it is based on creditworthiness. The safer bonds typically are issued with a lower interest rate because, again, they're safer, versus if you're investing in a higher risk bond, those investors will typically require a higher interest to compensate them for the risk. Depending on the term that the bond is issued, those coupon payments may vary in duration. Some are issued quarterly, some twice a year, some once a year, and some bonds even don't pay any interest until the bond actually matures. There are different types of interest payments for bonds. Most bonds are issued with what's called a fixed rate, so they pay the same fixed interest amount over the life of the bond. But there are bonds out there that have variable rates, and some of the most common ones are something called a floating rate bond. Those bonds' interests are tied to a variable benchmark within the bond market, sometimes the LIBOR, the Fed funds rate, and as that benchmark goes up and down, so do the interest payments made by those bonds. The duration that the bond is issued for also comes into play when bond investing. The longer the duration of the bond, typically the higher the interest rate the investor requires because they're locking up your money for longer. If you're looking at a 1-year bond versus a 10-year bond of similar quality, maybe that 1-year bond's paying 1%, but an investor might require 3% for a 10-year bond because it's going to take that much longer to get their principal back, and there's more risk that could happen over the next 10 years versus within the next 12 months. The big topic we're going to talk about today is interest rate risk because that's had the biggest influence on bond prices so far in 2022. Now, the way interest rate risk works is typically as interest rates go up, bond prices go down, and vice versa. When interest rates go down, bond prices go up. Now, where this influences the value of a bond is, we've talked at this point up to, okay, you give a company $10,000, they make interest payments, and then they return your money at maturity. But the value of that bond that you're holding can actually vary in value while that bond is in existence. So let's say that bond you bought is $10,000. Well, during the life of that bond, the value of that bond, you could sell it in the open market. It could be worth more than $10,000. It can be less than $10,000 if you sell it prior to maturity. And this is where interest rate risk comes into play. So if you just bought a bond today for a 10-year bond and it's paying 4%, let's say a year from now, interest rates have now gone up and the new 10-year bonds are being issued at 5%, more than the bond that you're holding. No one wants your 4% bond. They don't want your 4% bond because they can get the new ones at 5% for 10 years. So if you were to try and sell your bond in the open market, even though it's got a $10,000 face value, it might be, someone might only pay you, let's say $9,000 for it, because why would they pay you $10,000 for your bond at 4% when they can go out in the market and get a new $10,000 bond paying 5% over the life of that bond? But that's a two-way street. If you're holding that same 4% bond and then interest rates start to drop, now everybody wants your 4% bond because no one can get 4% in that similar value bond anymore. So instead of your bonds being worth, let's say $10,000, now someone might pay you $11,000 or $12,000 for your bonds because they just can't get 4% anywhere else. One of the ways bond investors help mitigate some of this interest rate risk is a strategy called hold to maturity. If you own individual bonds, let's say you give that $10,000 and you're just going to hold it all the way to maturity. You have no intention of trading it. All of the ups and downs of the value of that bond doesn't matter to you. You just want to make sure they make their interest payments and they hand you back your $10,000 when that bond matures. Versus, let's say, mutual funds or ETFs. Those are actually portfolios of sometimes hundreds, if not thousands of bonds. And the way mutual funds and ETFs value themselves is they have all these bonds, but they have to mark to market every single day. So it's like they have to liquidate all those bonds, and then that's what creates the share price. So when you talk about interest rates going up and bond prices going down, that has a bigger influence on mutual funds and ETFs because those investors don't have a choice to hold to maturity. They're marking to market every single day. Then I'll have investors ask me, well, then why would investors want to own bond mutual funds or ETFs versus actually just owning the individual bonds? And one of the main reasons is diversification. If you have $100,000 to invest in bonds, you may be able to run around and buy maybe 10, 20 individual bond holdings, but you're not as diversified as maybe a mutual fund that has, hundreds, if not thousands of bonds in there. So if one of those bond holdings defaults and you only have 10 bond holdings, you're at a lot more risk in that bond mutual fund that's much more diversified. And also fixed income investing is complex. People like to have that bond fund manager that's a professional that understands interest rate risk, duration risk, and over the longer term, they believe that by having that base of knowledge, they'll be able to outperform them. And again, while interest rate risk is kind of working against bond investors this year, sometimes it works for you. When all of a sudden interest rates start coming back down and the value of those bonds go up, oftentimes those bond mutual funds and ETFs have an advantage because you're getting that price appreciation. One of the strategies that investors use to help mitigate these rising rate environments and the impact in bonds is by shortening their duration. So shortening the time that those bonds mature. Because if you think about it, if I'm holding a 4% bond and it matures in 1 year versus 10 years, when that bond matures in 1 year, I then get my money back and I can invest it at the higher rate. Versus if I own a bond for 10 years, I'm locked in at that lower rate for a much longer period of time, and I can't reinvest at the higher rate, which is more negatively impacts the price of that bond. So a lot of times rising interest rates, people shorten duration, so their bonds keep notching up at the higher interest rate. Similar to investing in stocks, it's very important to maintain diversification within the fixed income side of your portfolio. It's been an extremely challenging year for bonds, and it's just really important to understand why the market environment now with higher interest rates, potentially credit risk coming down the road, could put further pressure on bonds so that they can lead you to certain moves within your fixed income portfolio to help defend that side against the rising rate environment. I hope this was helpful. Feel free to reach out to me with any questions at moneysmartboard.com. Thank you.